Welcome back. My name is Patrick L. Young. I'm here with Toby the Pug, trying to explain some of the intricacies of investment in these hyper-volatile times for the world of markets. Now, I touched on something at the end of my last video. What we were looking at there was I mentioned how it really is something to be proud of when you profit from markets, and it doesn't matter whether you're buying or selling. Oh my goodness, of course, lots of people start getting very upset at that point in time because there is a school of thought that when you're in the equity marketplace, you should only buy. You should always only be a holder of those particular shares. But the truth is, there are lots of people who also, for different reasons, want to sell those shares. And that's actually very, very important to the lifeblood of markets. Ignore, again, the media blame storming that takes place across the world of financial media, and particularly in the political sphere, where, alas, if only our politicians were a little bit more financially literate, one might actually have a great deal more faith in many of them. The simple truth is, markets are complex. Remember what Paul Gallico said, the famous novelist. When he was already an established best-selling novelist, he used to go and report on baseball for the New York newspapers. People wondered at the idea of why he wanted to sit there in the bleachers watching these baseball games and, more significantly, working for what was a relatively modest amount of money reporting on the game. When asked, Gallico said, the reason he liked to go to the ball games was because all human life was there. Now, the best markets in the world represent all human life. They are very large, very complex microstructures through macrostructures of many, many different market participants. Why is this important? Because if you think about it, the valuation of a stock market, just like the valuation of oil or any other commodity, is essentially purely defined by the process of people voting with their money. And therefore, you want to have the most possible people voting with the most amount of money in order to be sure that the prices you're seeing are accurate. In financial markets, we call this liquidity. Liquidity is the process whereby you can easily buy and sell shares or commodities in a particular market at a particular point in time, and do so easily. Therefore, if you take, for example, shares in very large companies, something like, say, Apple Corporation, one of the biggest publicly listed companies in the world, their shares are super liquid because people own those shares right across the world. Large investors, small investors, and every possible kind of investor in between. And they are, therefore, by dint of the size of their market capitalization, how big the number of shares are that are actually available for trading, hugely liquid, trade consistently all the way through the trading day in New York where they're primarily listed. And this is important because liquidity is great. It allows you to buy and sell easily. And let's face it, take an extreme example. I've talked about them before. Classic cars. Look at property. Those are illiquid markets. It's very difficult to get through and do a transaction rapidly at any point in time. So the point I'm making here is, some people buy shares, some people are selling shares short. Some people have different time frames on how they're investing. All of that information needs to be in the melting pot of the price of a share or a commodity or a market. And that's why there are no bad actors as such who are transacting on the basis of legally held information. Those people are all creating a debate about what's happening in the marketplace, and of course, sometimes it can lead to incredible volatility. But as we see, at the point when people are stopped from selling short, i.e. selling shares that they're not allowed to possess, then rapidly the marketplace itself becomes a lot more chaotic. At the opposite extreme, if you go to the, at the ultimate extreme, if you even close the market, it usually tends to end very, very badly. As we've seen just recently, where the Philippine Stock Exchange was closed for a couple of days and prices dropped by 25% once the market reopened in one day. So, ladies and gentlemen, that's why buying, selling, short selling, trading in derivatives, no matter how one does it, it enables all manner of information to be priced into a marketplace. And while some days we might not like that information, as we don't at the moment because the COVID-19 world has led to assets collapsing in prices, nonetheless, the more information in the market, the more actors in the market, and the ability for people to buy or sell completely freely is vitally important for promoting liquidity and therefore making it easier for all of us to invest and divest when the time has come. My name is Patrick L. Young with a very volatile Toby today. I wish you a great day in life and markets.